Let's start with a number that might make you uncomfortable. A recent study found that nearly 60% of Americans couldn't cover a $1,000 emergency with their savings. But here's the real kicker. That same financial stress isn't just about unexpected car repairs or medical bills. It's about the things we actually want to happen. The dream wedding, the down payment on a first home, the birth of a child, that long-awaited sabbatical, or a comfortable retirement. We're so focused on managing the monthly bills that we forget to financially plan for our own lives. Today, we're changing that. You're not just tracking expenses, you are the chief financial officer of your life and your family. This is the Family CFO framework. Think about the last time you set a big life goal. You probably got excited, maybe did some research, and then you hit a wall. The question, how on earth do I pay for this? Most budgeting advice is backward-looking. It tells you to look at your past spending, categorize it, and try to save whatever's left over. It's reactive. It keeps you afloat, but it doesn't help you sail toward a new horizon. The Family CFO flips the script. It's a proactive, strategic approach where you fund your future milestones first, and then manage your daily life with what remains. It's the difference between being a passive observer of your money and being its active, intentional commander. The first principle of the Family CFO is to define your corporate goals. A real CFO doesn't just manage cash flow. They allocate capital to projects that drive the company forward. Your life milestones are those projects. You need to be specific. Saving for a house is too vague. Accumulating a $60,000 down payment for a $300,000 home in the next 3 years is a corporate goal. That breaks down to saving about $1,670 per month. See the difference? One is a wish. The other is a target with a timeline and a monthly dollar amount. Your goal could be funding a $15,000 wedding in 18 months, which is about $833 a month. Or building a $25,000 baby fund before our first child arrives in 2 years, which is roughly $1,040 a month. Give your goal a name, a price tag, and a deadline. That's your first strategic move. Once you have your goals, you must separate this capital from your daily operating funds. This is principle 2. Create dedicated capital accounts. In a corporation, money for a new factory isn't kept in the same account used to pay the electricity bill. It's ring-fenced. You need to do the same. Open separate, high-yield savings accounts for each of your major milestones. Label them clearly. House down payment, wedding fund, future baby. This is non-negotiable. Why? Because of what behavioral economists call mental accounting. When money is all in one pot, it feels fungible. It's easy to dip into your house fund for a vacation. But when it's in an account with a specific name, it becomes psychologically protected. You're not moving savings, you're raiding your future home. This simple act of separation creates powerful friction and keeps you committed to your corporate strategy. Now, how do you actually fund these accounts? Principle 3, pay your future first. This is the core tactical shift. The moment your paycheck hits your account, your first bill is to your future self. You automatically transfer those predetermined amounts, the $1,770 for the house, the $853 for the wedding, directly into your dedicated capital accounts. You do this before you pay your rent, your groceries, or your Netflix subscription. You are treating your life goals as the most important line items in your budget. This forces you to live on what's left. It's a fundamentally different mindset. You're not hoping to have money left over to save. You're ensuring your dreams are funded upfront, making your daily spending adapt to your priorities, not the other way around. Of course, a good CFO is always looking for ways to improve the company's financial position. Principle 4 is to conduct a quarterly earnings call with yourself or your partner. This isn't a casual glance at your bank app. This is a formal sit-down review of your financial statements. You look at your capital accounts. Are you on track? You analyze your profit and amp loss, your income versus your monthly spending. And you review your balance sheet, your assets and debts. This is where you ask the tough questions. Did we hit our savings targets? Where did we overspend? Can we find efficiencies? Maybe you notice you're spending $300 and a mission to one month on subscription services you barely use. That's an immediate opportunity to reallocate capital back to your down payment fund. This quarterly review turns budgeting from a daily grind into a high-level strategic session. Life, however, is unpredictable. A rigid plan breaks under pressure. So Principle 5 is to maintain a strategic R&AMP.DED and emergency fund. In business, R&AMP.DED is for innovation and opportunity. The emergency fund is for crises. You need both. Your R&AMP. D fund is for unexpected opportunities that align with your goals. A great deal on a wedding venue that requires a deposit now, or a chance to take a career advancing course. Your emergency fund is for the true crises, the job loss, the major repair. The standard advice of 3 to 6 months of expenses is a good start, but as a family CFO, you view this fund as essential business continuity insurance. It ensures that a sudden shock doesn't force you to liquidate your capital accounts and derail your entire corporate strategy. As your company grows, your strategy must evolve. Principle 6 is to plan for succession and long-term stability. For a family, this means retirement and legacy planning. It's easy to put this off when you're focused on more immediate milestones like a house or a wedding. But the most successful family CFOs run these projects in parallel. Thanks to compound interest, money you invest in your 20s and 30s is exponentially more valuable than money you invest later. If you're 30 and you want to retire at 65 with $1 million, you might need to invest about $450 a month, assuming a 7% annual return. Wait until you're 40, and that monthly number jumps to over $900. Funding your retirement isn't a separate goal. It's the ultimate long-term milestone that you must start funding now, even as you save for the nearer-term ones. Finally, Principle 7, don't go it alone. Delegate to technology. A modern CFO uses sophisticated software. You should too. Automate everything. Set up automatic transfers to your capital accounts. Use budgeting apps that sync with your accounts and give you a real-time dashboard of your financial company. Let technology handle the tracking and the reminders. This frees up your mental energy for the high-level strategic thinking, defining new goals, adjusting your plan during your quarterly review, and making conscious spending decisions. Your job isn't to manually track every coffee, it's to ensure the entire system is moving you toward your life's biggest milestones. This is more than a budget. It's a fundamental shift in your relationship with money. You stop being a bill payer and become a life builder. You move from reacting to the past to designing your future. It's about making your money serve your life's most important goals, not just your monthly expenses. Start today. Define one milestone. Calculate its cost. Open one dedicated account. Make your first transfer to your future. If you're ready to take full control and get more of these strategic frameworks, your next move is simple. Hit that subscribe button and ring the notification bell. We're here to give you the tools you need to succeed as the CFO of your own life.